go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I have a soft spot in my heart for today's topic as, farming and agriculture runs deep in my family's blood. As a kid, I always knew that springtime meant planting crops while the fall meant harvest time. Well, the first thing I thought about as a kid during that time was being able to get to ride on the tractors and all that fun. I definitely wasn't thinking about the prices of those crops we were harvesting or investing in futures at that time. Well, today I have on the perfect guest to talk about investing in grains and why today is a great time to be a buyer of grains. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. Now, I'd like to give a very warm welcome to Sal Gilbertie. Sal is the CEO of Teucrium ETFs. Sal, thank you so much for coming on the show. It's an honor to have you on. I'm really excited. Just like I said at the opening, this is going to be really fun conversation. I'm really excited for it. Can you please tell us a little bit about yourself and Teucrium and maybe how you got started?
Sure, Ryan, and thank you for having me. It's an honor actually to be on your show. It's wonderful. So thank you. I think we're both sitting in beautiful places right now. I'm in Connecticut in the midst of a spectacular autumn. I just drove down from New Haven to my office, and the leaves are just amazing. Blue sky, beautiful leaves, and life's wonderful. And I think it's good weather like this through the whole country. We're in mid-harvest, the height of harvest, and everything's going great for the farmers. So how I got started, I'm actually sitting on a certified organic farm right now. That's my family's. Always think about ags, but they happen to grow herbs, not the big row crops that we're about to talk about. But always had a soft spot for ags. I started my career in Cargill a long time ago, and so started trading actually energies for Cargill, but cut my teeth in their training program. Was in a grain elevator in Iowa. Had all the good fun that a guy could have in grains and in farm country. So it was really wonderful. And along the course of my career, where I left Cargill, I went into energy and ag, trading and brokering, and mostly trading, and ended up at Societe Generale, the division of SocGen. And I started the ethanol contract. Basically got that listed. I heard George Bush give a speech on ethanol, and I had blended gasoline for Cargill. And I thought, wow, I'm familiar with additives. I took Cargill, this is how old I am, I guess, from leaded to unleaded. It's a very long time ago. And then I saw, well, wait a minute, unleaded gasoline has MTBE in it. It's a chemical that causes cancer. When I heard about ethanol, I go, wait a minute, you can drink ethanol. It's just grain alcohol. That is the future for blend stock inside of gasoline. And I thought that was wonderful. And I got a desk going there at SocGen. It turned out to be a renewable fuels desk, is what they called it. And we traded, of course, energies and grains, and it was really wonderful. And from there, I started Teucrium because I found out about ETFs by happenstance. I didn't know what an ETF was. Yeah. And the guys who started one of the big name oil ETFs had been in an office downstairs, and I worked in Rockefeller Center in New York, and I was called into this meeting where I heard an ETF described, and I thought, wow, that's amazing. You could trade oil on the New York Stock Exchange, or you're going to be able to. Yep. And I had never been able to trade oil for my personal account because I always traded for the house, and it was a conflict. So if I wanted to go long oil, I had to buy Exxon or Mobil. They were actually separate companies at the time. And so I thought that was the greatest idea I ever heard. And I was amazed that there weren't agricultural ETFs. At the time, there was only one fund, DBA, it was the old DBA that had 25% corn, soybeans, wheat, sugar. Had a few $billion in it, wonderful. But I couldn't believe there wasn't a corn ETF. There wasn't a soybean ETF. There wasn't a wheat ETF. It blew me away. So I started Teucrium to actually fill that gap. That's what we did.
Love it. Love it. That's one of my favorite parts about ETFs is just you can get exposure to so many different spaces for the retail investor that years ago you couldn't get exposure to. And it helps just build better investment solutions for investors, which ultimately is the end goal. I love that you mentioned Cargill. Growing up in Wisconsin, going to school in northern Minnesota or central Minnesota at St. Cloud State, Cargill was a big name for hiring. I think I applied to Cargill out of college numerous times, got shot down numerous times, rejected, but Cargill is always such a big name, big powerful name in the Midwest. In turn at St. Cloud in terms of hiring too.
Sure, it was good fun, and I was in their Minnetonka office to
Okay,
start out, and it was really really fun. Yeah.
fantastic. Let's talk about grains and harvesting. You talked about now is a good time for the weather has been fantastic for farmers and for harvesting their crops. You've gone on record and produced some fantastic content about saying that we're currently in a golden grain cycle. Can you please explain to us what a golden grain cycle is?
Sure. And I'll have to say that that title was the brainchild of Jake Hanley, our senior analyst. He's terrific. But yeah, the golden grains are a pretty simple commodity in that they trade at cost of production. So just a bit of history, agriculture in every country of the world, farmers are subsidized. And the reason they're subsidized is, nobody wants to run out of food. You lose power. So every politician in the world is going to subsidize your farmer. Well, farmers, because of subsidies, get used to operating at break even. So it may sound strange, but the big grains like corn, soybeans, and wheat, okay, farmers are used to operating at break even because they get subsidies, and it's okay if you're just breaking even. I mean, it's great if the price goes up and you make more money, okay, but you can operate with all the subsidies and all your tax law and your depreciation laws and things like that. You can operate your farm at break even and have a farm and a place to live and produce some good crops for humanity. So it's wonderful. So crops trade at break even until there's a supply disruption. And the reason I say that is we've done the studies back to 1960, the combined use of corn, soybeans, and wheat globally, every single year since 1960, and again, we only went back to 1960, is a record or near record. So it's either the first or second highest use of corn ever, first combined use of corn, soybeans, and wheat. So if you have basic economics, okay, if you have a demand that is only rising over time, it's only getting bigger. If you have a supply disruption, the demand isn't going to stop, okay? No one stops eating their bagel in New York City if it doesn't rain in Kansas. They don't care. You still need wheat to make that bagel, okay? Yeah. But if it doesn't rain somewhere, the usage of grains doesn't stop. And so the golden grain cycle is based upon, there's a 3-stage cycle. One is normalcy, is grains trading at break even. And we'll just use corn as an example, okay? Break even of every farm is different, but you can deliver corn into the futures exchange. Yep. So if you put up a chart of the spot futures, so the front month futures, okay, the most active contract futures, and you look at it for the past 17 years, and we only go back to the Renewable Fuels Act, okay? Prior to the Renewable Fuels Act, corn traded between $1.75 and $2 a bushel, okay? That was its break even. And it would pop above that if you had a supply disruption, okay? After 2007, 2008, okay, when we passed the Renewable Fuels Act and grains became a part of our fuel supply and part of the modern global economy in so many different ways, all right? It literally doubled everything. So now corn's break even. So the futures equivalent break even. Again, the futures, you look at spot futures because every farm has a different cost, but you can just look at spot futures, and you don't have to be a farmer to figure out the break even. Where does the chart say trade sideways? Where does it stop going down, trade sideways? For spot corn, that's between $3.50 and $4 a bushel. It used to be $1.75 to $2. It literally doubled, okay, since 2007-ish, all right, since the passage of that act. If you look back at a spot continuation corn chart from the 2006-07 crop year to now, okay, corn roughly trades between $3.50 and $4 for prolonged periods of time, and then there's a supply shock, generally due to a drought, and it's doubled. Okay, that's happened 3 times. This is fact. It's not conjecture. You could look back. So stage 1 is when you're actually at break even. So corn's just sitting there trading between $3.50 and $4. Okay. Stage 2 is when the market senses there's a supply disruption looming, and that's generally when it stops raining in the summer in the northern hemisphere. Okay, and the price is going up. That's stage 2. Stage 3 is when you're on your way back to the cost of production. Okay. So if you look back at a chart, and the golden grain cycle is illustrated on our website, you can go to our website under the research section, just click on golden grain cycle, and it will come up. We update it every Friday, the spot futures price. And you can see that 3 times since 2006-07 season, corn has traded around $3.50 to $4, and then suddenly papped higher to around 7.50, 50 cents either side of 7.50. And here's how we put it. If you said to anyone, I have an asset that starts from the same number, okay, and I can't tell you when it will happen, but it trades at break even, has very limited downside. Okay. And we've done the study. So if you look at corn between $3.50 and $4 the last 17 years, excluding the 6 months during the COVID panic, okay, it never traded more than 8 consecutive weeks below 3.50. Okay, spot corn futures they don't hold it. They dip down, but guess what? That's below break even. Corn farmers stop selling or stop planting, you go back up again. Okay, there is a historical floor on spot continuation corn futures prices under 3.50. There just is. Okay, the natural futures equivalent break even seems to be between 3.50 and 4. So if you say to somebody, I've got an asset that trades at break even, it trades at X, and 3 times in the last 17 years, it has gone to 2X and goes back to X. Okay. Yeah. The logical thing any asset allocator is going to say, this is not a short-term trade. Okay. You don't know how long it's going to take. It's an allocation. It's an allocation in that you're going to park your money in there. This is what people have done, and wait. So we had an advisor actually who was really clever. He said to us, I see corn under $4 and I weight it, WEIGHT, into my portfolio using your fund. Okay. I weight WAIT, sorry. Okay. And when there's a drought, I get out. So it's wait, drought out. We thought that was pretty clever. We say it all the time. And that guy, he said, look, if I put 1% of my portfolio in your corn fund, I know that when spot corn is under $4, I do have limited downside historically. Okay. Yeah. If I'm sitting with a client and they say, why do I have corn? I say, well, it's for diversification. And I'll get to that in a minute. But it's for diversification, and it goes down, say 10%. Okay. It goes down 35 cents a bushel or so. All right. If I have 1% of my portfolio in there, I've affected their portfolio by 0.1%. Okay. Mm-hmm. In the years that there's a drought and it doubles, I turn my 8% target portfolio into a 9% target portfolio. I'm a hero. Okay. And I got out. So, and he said, I understand. And so we have on our website, there's also a study showing our tags. So the Teucrium Agricultural Index, and that's only been around since 2012 when we put it up. Okay. When we look back from 2012 to now, the S&P 500 has pulled back 10% or more 7 times. 7 out of 7 of those times, the agricultural index has outperformed, sometimes very, very significantly. So you have an asset that is, when you're at these levels, okay, and we happen to be right around $4 spot corn right now, okay, and that's due to harvest, okay, yep. Peak harvest. So there's a seasonal here that has to do with all of the grain being harvested in the Northern Hemisphere at the same time, and that's right now during October, okay? So you get a natural seasonal low. You also happen to be at that futures break-even equivalent low, which has taken us a couple of years to get back to since the Russian invasion of Ukraine highs, okay? So we're at the lower end of the 17-year price band, entering the futures equivalent break-even at the seasonal low with an asset class that really doesn't correlate to the S&P 500. That's a natural trifecta that every asset allocator wants to see. And so it's very easy to invest in these things. And corn is amazingly liquid, decabillions of notional value trade in the corn market. There's no investor listening to us, no combination of investors listening to us, that is going to be willing to put in enough money in a single day in, say, corn, that it actually moves the corn market. It's not possible. So these are highly liquid. They're there. They're transparent. You can see the price, and it's a wait, drought out type of thing is what we're told by investors.
Fantastic. I love it. We'll talk more later on about the impact corn and grains have on investment portfolios and get a little bit more into the investment side and portfolio management side of it. But going back to the golden grain cycle, so You did a great job explaining to us. I loved it. But is it more about that price that we're currently sitting in? More, are we looking at a supply shock, like you mentioned, supply demand, or is there something else that maybe you believe why we're currently in this golden grain cycle?
Why we're where we are in the great cycle, and where we are is in stage one. So we're already back down at the break even level, which again is roughly $3.50 to $4 futures equivalent. And some people are saying that, the break even may be a little higher now with the inflation, with fertilizer costs higher. I mean, that could be. Futures will tell us. We have not managed to hold the price below $4 at all for more than a day or two here in the last few weeks. So, and this again is the seasonal low. Okay. So the seasonal low time, because it's during peak harvest. So a lot of people are looking at this going, well, wait a minute, this may be a time to look at this. And I look at it this way. In fact, I just read a thing Van Eck put out this morning. It just so I had to hit my mailbox somehow. And they said gold should be in everybody's portfolio. Well, I just want to say gold is not the only golden commodity that should be considered for your portfolio. Okay. I'm not telling anybody to buy or sell here. We do not give investment advice, but look at grains are really liquid. Corn is down here at its seasonal low. It's down here at its 17-year price low. It has much more based on the 17-year history. It's got historically much more upside potential than downside potential right now. And it does not correlate with the S&P 500 well at all. It is the holy grail of an asset allocator's desire to get something in your portfolio that's going to stabilize it. Okay. And it's October too. People get nervous.
Yeah.
Like, it so happens stock market makes new highs just about every other day here. But, people are looking at it going, how long can it last? How much damage can an asset do that is nearing its 17-year floor price? Okay. That literally has doubled 3 times in those last 17 years from this approximate price and doesn't correlate well with the S&P 500. It is, one guy said it's the holy grail of asset allocation. So here it is. You don't just have to look at gold. Corn is, the yellow commodity too that people should be looking at.
I love it. I love that, talking about the impact that it has on portfolio man. And it is a great diversifier and a great hedge. I wouldn't even say hedge, but it helps, stabilize a portfolio. And we are looking at, you mentioned it. It's crazy how resilient markets have been over the past couple of years, regardless of the uncertainty. The Fed's cutting rates, so that helps some optimism. But we have the presidential election, many other elections around the globe. That brings uncertainty. You're thinking about a slower economy in 2025. So there's a lot of uncertainty out there that, where corn could have a good impact on that volatility.
Sure, corn or grains. I mean, let's face it, no matter who the president is, no matter what the latest iPhone version is, no matter what's happening anywhere, no one is going to let their family go cold or hungry, their family or their animals. And corn's number one use, in fact, most grains' number one use, except for wheat, is to feed animals. Okay, that's what it's for. So if you're consuming meat, you're consuming grains. If people trade what they know. When oil goes under $50 a barrel, the number of people that add oil to their portfolio and they say, I'm just going to hold it till it goes back to 100. That might take a day. It might take 10 years, but that's what I'm going to do. Well, guess what? Corn under $4 is a whole lot like oil under $50. It just is. And corn brings everything else down with it. Corn and soybeans share acres, so soybeans come down. Wheat, I mean, we saw, I think, 600 million go into our wheat fund when Russia invaded Ukraine in a matter of weeks. Okay, these funds can take in immense amount of money, no matter how big or small they are. They can withstand, huge contributions and huge withdrawals because of the underlying liquidity. And that's a key to the ETF market here. Okay, and I'll just add, it's really important for anybody trading ETFs to not trade at the open and not trade at the close. These are not mutual funds. These are not securities. Okay, securities in the sense that you're buying a stock and you could say, I'll just take the closing price. These are arbitraged. Every ETF is arbitraged against an underlying. So the best time to trade an ETF is give everything time to open, all their underlying components time to open. Best time to trade an ETF is 15 minutes after the open. So 9:45 a.m. New York time. The worst time to trade an ETF, in my opinion, is right at the open, right at the close, because machines do the pricing and all the components may not be open yet, and you're going to get a bad trade, okay, eventually. So the best time to trade a commodity ETF is between 10 a.m. and 2 p.m. Eastern time. That's if you're willing. Never use a market order ever, 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 because if a machine has an aberration, your market order will get filled at a bad price. Put a limit price in, the aberrations are corrected within milliseconds or seconds, and you don't want to be inside that millisecond and get the bad fill. So put a limit price in, and the machine will correct and get to you if your price is anywhere near value.
I love that those tips of advice for ETF investors. ETFs are, don't want to change the subject here, but they're so popular. We see it in the headlines all the time about how the inflows in AUM into ETFs is just growing, and you're getting all these new ETFs out there. So great advice for all you investors out there and financial advisors when you're trading ETFs. I love it. We talked about the economic slowdown. Interest rates are falling, hence probably economic slowdown on the horizon. Many are calling 2025. We're not going to get into whether it's a soft landing, recession or not, but how does the economic slowdown, if there is one, impact grain prices?
It doesn't. Again, nobody stops eating. Or here's the thing: if you have a real, true, huge economic slowdown that we've not have in generations, a true one where your energy usage goes down. Okay, because corn and energy and grains and energy are highly correlated. Number one, because of the input cost, because if energy is high, then the cost of break even is high for your grains or anything else you produce, anything. But second, corn produces ethanol. That happens to be corn's number one use in America. Close second is feeding animals. Okay, but number one use in America is ethanol, and ethanol's in your gasoline. So if all of that gets cheaper, okay, the economics do back into corn. So if you see an absolute collapse in energy usage, particularly motor fuel usage, that is going to negatively affect your corn price. But again, you've got these separate set of economics where when you look at a futures continuation chart, and I keep using corn, but you can group the grains together, like the Teucrium Agricultural Fund is corn, soybeans, wheat, and sugar, by the way. And that's the one that really doesn't correlate well with the S&P 500 at all. None of them do. Okay, none of them do. Yeah. But that's the study we've done. So in that one instance where you see motor fuel use going down, you will see the use of grains go down. That said, again, there's a floor on grains. Farmers will just stop selling. They just keep it stored. You can store it for a while and they'll just stop selling.
Interesting. And I love that fact that when I think of corn, I'm probably in the minority here, but when I think of corn, I think of food, whether it's you're feeding animals or feeding your family. I don't necessarily think of corn's number one use is gasoline and energy, and part of, obviously it's obvious now with ethanol and stuff, but I'm really glad you brought that up, and the uses of corn. It's so widespread. It's not just eating corn on the cob during the summer.
Okay, that's very interesting. I think the majority of people think about corn on the cob and popcorn maybe, but on the pie chart of corn usage, you can't see that slice. Okay, the slice is directly consumed by humans. Okay, is so small, it's amazing. Now, okay, we use the corn in the service station example. So you pull into your petrol station, and you start filling up with gasoline. All right, ethanol's in that gasoline, and that's corn's number one use in the U.S. Mm-hmm. Your kids run in and buy the beef jerky stick snacks, whatever. Okay, that's corn's number two use, whether they grab the chicken tacos or the beef jerky sticks or whatever. Okay, that's been used to feed animals. Interestingly enough, the number three is if you're on an expensive trip and you print out the receipt, paper has starch in it. Corn starch is the number, so making paper, that's got corn in it. Corn starch is the number three use. Okay, when they pull it actually might be the number four, because number three use might be sugars. Okay, so if they pull those Snapple drinks or whatever drink they pull out of the cooler to wash down their beef jerky and chicken taco, that's corn syrup. I mean, it is not possible in the modern global economy, in any country, to not be consuming corn or grain. Remember, soybean produces soybean oil that's in biodiesel. Okay, wheat, bad wheat that's a poor enough quality to put in for human consumption, but not a bad enough quality to throw away. That goes into ethanol plants. Sugar, obviously, Brazil is most efficient at making sugar into ethanol, and in fact, that's the most efficient ethanol there is. Corn, you've got to pull the starch out of the corn, okay, to grab the sugar, to create the sugars to make the ethanol. So it's a two-step process for corn-based ethanol. It is not possible to not use grains. You can't do it. You can't do it. No matter who you are in the world, you cannot not use grains. Everybody thinks about oil. They think about gold. Why aren't they thinking about grains? I don't get it for a well-constructed portfolio. I just don't get it.
Yeah, it's and I'll be the first one to admit I don't. And I'm so glad you came on to talk about it and the importance of, you know, agriculture and corns and grains and wheat, like you said, but bring in exposure to it as an investment and the importance and the role it can play in portfolios. And now you mentioned it, it has a very low correlation to the S&P 500. So it plays really well in portfolio construction. What are some other considerations financial advisors should make when including grains or corn for that matter in portfolios? Should we consider how should we consider the investment? Should we buy and hold, long-term investment, more strategic, thematic, or and what's a percentage of allocation? I know
Okay.
everyone's different, but
Yeah, everybody's different and they have to decide it for themselves. So we have a lot of advisors tell us they put 1% in. Okay. We've got a few who say they go as high as 5%. I think a lot of people look at it like a gold allocation. So they'll have from 5 to 10% in some alternative that stabilize their portfolio like precious metals. And I think they take some of that and put it in corn. I don't think they add. So if somebody's got a 5% allocation to gold, they might take 20% of that. So they got 1% in corn and 4% in gold. You see what I mean? I don't know. Everybody's different. I do know that when you're at this trifecta price that we happen to be at now, where you are at the 17-year historical low of the price range. Okay. You're entering that break even type area of spot corn being around $4 or below. You are at the seasonal low, okay, where this because of peak harvest, okay. And think of it this way: there's a big pile on the ground. The world's taking from that pile. So once the harvest is done, the pile starts getting smaller and smaller and smaller. Through the winter, nothing's growing. Through the spring, you're planting, but you're not harvesting. Through the summer, you're watching it grow, but you're not harvesting. You're not harvesting until the next year. So the pile keeps getting smaller for a year, and anything that happens to not have that pile be replenished adequately scares people a lot. And that's why you have these big 100% price moves, in short periods of time when there is a drought. But over that 17 years, again, under 350 is really limited. So you have limited downside. Okay. 3 times you've doubled. So you have actually very significant potential upside based on history. And again, past performance is not indicative of futures results. We all have to say that. Okay. And you just don't correlate with the S&P 500. It correlates. Everything correlates. Okay. And the bad days, everything goes down. Right. But guess what? That correlation separates. And when you get the agricultural index 7 out of 7 times outperforming the S&P 500, sometimes really significantly. And again, you could find these studies on our website or call us. We'll get them to you. So you look at it as you have limited downside, you have a portfolio stabilizer that on the really bad time periods of prolonged bear markets with the S&P 500, that part of your portfolio is kind of stable historically, and it should stay that way. And two, well, three, you have positive alpha. Your surprise is going to be the upside when you're at this level. Okay. Your surprise is going to be, wow, that just popped some alpha into my portfolio unexpectedly. I'm happy about that. So I think that, those are the ways you should look at it. I can't tell people what to allocate or how to allocate. Again, it's a mystery. If you got gold and oil, if you're one of those people that's listening that has gold and oil as a core component, and again, this is not a set it and forget it. Okay. When you put 1% in your portfolio, if suddenly you notice that's 2%, look at it, wait, drought out. You can't just, this isn't a set and forget it. But over that 17 years, one time you had to wait 1 year. One time you had it when you put it in stage one until you got to the top of stage two, you had to wait 1 year. One time you had to wait 2 years, and one time you had to wait 6 years. Okay. So you just don't know, but you do know that again, historically, your downside is limited, your upside is potentially significant, and it really, really will act as a portfolio stabilizer. It doesn't care who the president is, what your iPhone is, what the S&P is doing. It doesn't care. You're still going to eat your bowl of cornflakes and drive your car and use your diesel food. You're still going to do that.
I love it, Sal. Sounds so great. I love for all the listeners out there now who are really intrigued by adding corn, if you don't already, or grains, for that matter, how can financial advisors and investors gain exposure to this asset class?
Well, I think if you can trade futures, go trade them if you have the time,
Okay.
okay? But if you can't, and most people don't, including institutions, aren't allowed to trade futures, there's an art to it and there's risk to it. We've packaged them in ETFs. So our ETFs are you know, our tickers are pretty simple. Corn, CORN is the ticker for our corn fund. Okay, tags, TAGS is the Teucrium agricultural fund. That's the study I keep referencing. That's our multi commodity. We have TIL, which is a 40 Act fund, so it's no K1. It's basically 25% each: corn, soybeans, wheat, sugar. We have soybean, SOYB, wheat, WAT, no H, and sugar is cane, CANE. You don't have to remember those. You can just go to teucrium.com and find us. You can find us at Teucrium ETFs on X. Look, we're around. You can internet search it on whatever search engine you look. You will find us. Remember the golden grain cycle. It does update weekly. Check the date on it and make sure you're on the most recent one. But we're here. We are trying to educate people with brief pieces. You can sign up for our newsletter, which only comes out twice a month. If that, we don't pound your mailbox. We won't call you. You have to call us. You have to say, I want to be contacted. You have to sign up for our newsletter, and you'll get things from us that are short, to the point, and we will not harass you.
I love it, Sal. Thank you so much for coming on the show. I love your passion for this space, your knowledge. Thank you for sharing so much information. I learned a lot. Sure, our listeners will. It was such a fun conversation. Uh, and I urge our listeners to go to your website, because I went there. There's some fantastic insight there. I learned a lot leading up to this conversation. So thank you so much.
Thank you, Ryan. It's a pleasure to be here. Thank you.
Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.